All right, good morning, clients. Welcome to this week's webinar. Now, before we start, big apologies to all those who logged in last week but couldn't find us around. We were having technical issues with our platform and couldn't log on. So the best thing we could do was to send out email blast to inform you guys about the cancellation. So hopefully most of you caught it before the start of the webinar and then did not have to log in and wait for us. Okay, for this week's webinar, we will be touching on Croetia's retail trust. This is a trust that we initiated on in April last year. So since initiation was such a long time ago, today I'll touch on some of the updates for the company. What are the drivers for the DPU growth going forward, and as well as some of the updates for the Japanese economy as well as the retail scene over there. So Croatia's retail trust, what is it exactly about? Croetia's CRT is actually a retail trust in Japan. They have 7 malls in Japan, predominantly suburban malls. Their malls are mainly catered to the locals in the area. So they have 2 malls in Tokyo, one in Osaka, and then 4 more around the country. IPO malls were number one to number 4, and then 5, 6, 7s were acquisitions post IPO. So since our initiation last year in April, how has CRT done? Since initiation, we saw that CRT actually returned 7.7%, outperforming the STI return of a negative 4.6%. And these returns include dividends. So we see CRT performing pretty well there in comparison with the main index. So a little bit more about CRT and why we like it. CRT has a long weighted average lease expiry, and that is the WALE. The WALE is 8.6 years because typically in Japan, retail leases generally last for a longer period as compared to the typical 3 years for retail malls in Singapore. So for CRT, we see a WALE of 8.6 years with about 72% expiring only beyond 2019. So 2 ways to look at this. There is stability in the long WALE, and people who like it will like the stability. But on the other hand, so people who don't like it will say, okay, if your WALE is so long, it's likely to be boring. Where is your growth going to come from, right? So what management has said is that they are very confident on retail sales, Japanese retail sales going forward. Right now, CRT has about 88% of gross rental income coming from fixed rentals. So 88% is fixed and the other 12% is from variable sales. So if retail sales does better, then the 12% portion will increase as well. So right now what management is trying to do is that they are trying to increase the variable portion of leases. So for the last FY, which just ended in June this year, there were big renewals for this mall, Melage Shobu. This mall accounts for about 20% of CRT's GRI. So for the last financial year, they renewed about 155 leases out of 240 leases for this mall. These renewals are likely to be the main DPU drivers going forward because the old leases were mainly contracted in 2008, and that was at the trough, near the trough of the GFC where rates were pretty low. So we saw rental reversions of about 20 to 25% over this period. And another thing about CRT is that about 2/3 of their leases are fixed leases. So in Japan, there are two kinds of leases for retail malls. There's the fixed lease and there's the standard lease. So how different is it? How different are these two leases? Let's talk about standard leases. So fixed versus standard. Standard leases are those which actually favor the tenants because for standard leases, tenants have the choice at the end of the lease term to decide whether they want to renew or not. So in that sense, landlords actually do not have the discretion as to whether they want to kick out the tenant if they're not performing well, or they see that the crowd in the area is turning into a different demographic. They want to readjust tenant mix. If a mall has more of that kind of leases, then the landlords would be rather tight if they want to readjust the tenant mix. But for CRT, they have a good two-thirds of their leases being the other kind of leases, which is where the landlord is able to adjust or able to choose or kick out tenants at the end of the lease if they want to. So the other driver for DPU growth going forward is likely to be once more, which the management acquired at the end of last year. So from our meetings with management, next 12 months growth is likely to be organic growth coming from Malak Shobu and once more. So now we talk about some of the macro stuffs in Japan, which are likely to be favorable for CRT. In in 2007 and 2008, we saw a glut of shopping center supply in Japan. This is not unlike what we saw in Singapore for our office space, where we had a glut of office supply in 2008, especially, which unfortunately coincided with the GFC, and then the double whammy led to rental indexes just collapsing. So Japan saw the same phenomenon in '08 and '07, but in their retail scene. And why this is so is because in 2006, there was this amendment to this law that Japan had. So basically in 2006, the government made it more difficult for developers to develop malls which are more than 10,000 square meters in size. So because of that new implementation, a lot of developers actually rushed to submit applications for more developments in 2006. So post all this, the spike in the application submission, 2 years after that, in '07 and '08, when most of the applications and the malls start to get completed, we saw a spike in the supply. But right now, post that spike, I think we are seeing a gradual stabilization in the supply of shopping malls. So if you look at these two charts, you see that in the 2 years leading to 2012, you see cap rates actually stabilizing. So we had the GFC, we had the collapse, and then we had this recovery post GFC. And then from 2010 to 2012, basically cap rates were flat. So cap rates is actually is an expression of the ratio of rents versus the valuation of your property price. So if you are getting the same rent, and if you see post 2012 where cap rates are compressing, if you're getting the same rent and cap rates are compressing, that would actually just mean that prices and valuations of your malls are increasing. So by end 2012, we started to see cap rates compressing, and that coincided with the period where PM Shinzo Abe was elected up. And that was also the period of time where he started to launch his Three Arrows program for his stimulus, which is also termed widely known as Abenomics now. So for Japan, when we talk about consumption expenditure, there are various ways that consumption expenditure can actually be boosted. It can be boosted if the GDP is doing well. You see an economy where people start to get more jobs. So employment rates go down, people get more jobs, they get more disposable income, and they spend more. Or the other factor could be unemployment rate stays the same, but wages go up and they spend more as well. And the third thing would be if household leverages start to get higher. So for Japan, we see that Japan's real wage growth year on year actually started to turn positive for the first time in 2 years in April this year. And in January this year, they actually saw wage rises which were highest in 15 years. So if you look at the second chart at the bottom as well, you see that Japan's unemployment rate is also slowly trending down post GFC from 2010. So in in July this year, we actually saw an unemployment rate of about 3+%, and that rate is actually the lowest rate Japan has seen in the past 18 years. So we think that for Japan, these two phenomena will actually provide a support for consumption expenditure going forward. So the next factor to consider in favor of CRT is that for there was this retail sector market review done by CBRE in 2013, and they actually found that there were several shifts in the social trends in Japan in recent years. And one key observation is that from the past, where people used to like shopping in nearby supermarkets, there was actually this shift in shopping habits to favoring weekly family outings in large shopping malls, where you can find other entertainment and leisure facilities for your families. And in 2014, CBRE did another survey, a similar survey for Asia Pacific consumers. And they found that in Japan, if you look at the bottom chart for across age groups, most of them, predominantly a large part of them, prefer shopping in shopping centers and departmental stores versus the high street shops that you see. And this kind of just reiterates what the market review the previous year actually found out. So for CRT, after our chats with management, we estimated that their portfolio occupancy costs range to be in the high single digits, which should be in the 8 to 9% range. So as a guide, for Japan suburban malls, the average occupancy cost is about 12 to 15%. For if you look at Singapore suburban malls, if you look at CMT, for example, CMT is doing about 17%, FCT is doing about 15%. So if you look at CRT's occupancy costs, an 8 to 9% is actually pretty low. So for those who are not aware, occupancy cost is actually the ratio of the rents you pay versus the total tenant sales. So if a tenant, he makes for every $100 in sales that he make, if your occupancy cost is 8 to 9%, then you're actually paying $8 to $9 per $100 of sales. So CBRE did this Japan market survey as well, and they actually polled different tenant categories of different tenant categories with different gross margins, and they found out that a sustainable occupancy cost, the rent ratio that tenants can actually afford to pay in the long run, will range from in the high single digits to the mid-teens. So when we see that CRT's portfolio occupancy cost is in the 8 to 9%, it's actually at the lower end of the sustainable range. And what this means is that when your long leases come to renewal, the tenants actually have a lot of room to play in the sense that they can actually afford higher rents if CRT were to bring prices up. And we are also supported by the fact that post GFC, we see that Japan retail sales have actually stabilized. We see that post 2010, after we saw a few years of negative retail sales growth, we saw that post 2010 there was actually a stabilization of retail sales. So we talk more about micro levels, micro stuffs for CRT now. If you look at CRT, the 7 malls that they have, the first 4 are the IPO malls. The last 3 are the acquisitions post IPO. If you look at the occupancy rates for the 7 malls, they are all pretty decent across all quarters, mostly trending close to 100%, trending close to full occupancy. And for CRT, you look at the purchases of the malls of the 7 malls. In fact, most of their malls are pretty new. Their the completion date of the malls are mostly post 2000s. So all very new malls down there. And if you look at the timing of the purchases that the management has done, they have actually displayed pretty good sense and judgment in that. For all 7 malls, if you look at the latest valuation versus the purchase price, upsides actually range from a 3.4% to a 10.8% from what they paid for the malls. if you compare with other trusts, like if you look at Sizen, they have a pretty good number of purchases which are actually below purchase below the purchase price that they entered into for the residential apartments that they bought. So in that sense, there is this there is this okay for CRT they are actually their asset managers fees are actually slightly higher than what you see for typical retail trusts retail REITs for S-REITs. And there is actually this saying going around that their fees are so high, and one of their malls, the management fees is also slightly on the high side versus what typical retail REITs charge. So because CRT IPO'd in 2013, so I think track record wise we can't see a very long track record. It's just 2 years of performance for us to judge. But I think I suggest I advocate giving management more time, because as of now we see that the judgments they have made are pretty on tune. So I think right now when people invest in REITs, they would have two main concerns. One is rising interest rates, which actually affect equities as a whole as well, not just REITs, but rising interest rates is one concern. And if investors were to buy into CRT, I guess one of their main concerns would also be the FX translation losses, because we see JPY, I mean, like on the back of Abenomics, right? If JPY were to continue to weaken, then that would affect the DPUs that CRT is able to give out, because they collect rents in Jap yen and they distribute in Sing dollar. So on that note, we show you this chart. That is, if you look at the blue line is actually the Bloomberg Composite Index for the forecasted Sing dollar to Jap yen rates going forward. And this is actually the consensus economist estimate for the next few years. And if you look at the red line, that is actually what we have projected in our valuation models. So for 2016, what CRT has done is that their policy is that they try to hedge at least 1 year forward. As of the latest hedging, they have actually hedged until first half 2017. So for our rates for 2016, we have actually used 85.43, and that is the hedged rate that CRT has managed to achieve. And if you look at 2017, 18, and 19, we are using a 90, 92, and 96. And you see that these exchange rates are actually more conservative than what the consensus economists forecast is. So I guess in that sense, our valuation model and the target price that we have deduced for CRT could be said to be already on the prudent and on the safe and conservative side. And if you add that to the fact that we have inputted a risk-free rate of 3.1% for our valuation model. And for this, we are using the Singapore 10-year bond as a proxy. And if you look at the 10-year bond yield now, it's just doing 2.8, 2.9%. So we are also giving some room for further increases in interest rate hikes. So on those two fronts, we actually have already factored in a more prudent estimation of the target price. So on that note, we maintain our buy call on CRT, notwithstanding the fact that we have lowered the target price from 108 to 96 cents. So versus the last close price on Thursday, 84 cents, including dividends, you are looking at an upside of about 22% from 84 to 96 cents for the next year. So with that, we have come to the end of the webinar, and we welcome questions. There are some questions on CRT, and I think bulk of the questions is relating to how interest rate hikes would affect REITs, and in particular, how would it affect CRT. So as already mentioned earlier on, we in our valuation inputs, we have actually already factored in a risk-free rate of 3.1%. That is actually higher than what our 10-year yields are trading right now, 2.8 to 2.9%. So in that sense, we have a buffer there. You can say that our valuation, our target prices already have built in a buffer for interest rate hikes. And I think, like mentioned previously in our various sector reports, we see that um, going forward, there are headwinds for various sectors for the REITs, for the different REIT sectors, including retail, including commercial and industrial. So we actually advocated a bottoms-up approach when we come to choosing REITs. So for the REITs that we cover, we actually think that the growth drivers are still intact, notwithstanding the fact that rate hikes will actually increase funding costs for REITs. But we also know that when rates hike, it actually is usually on the back of generally improving economic conditions. And a question on the leases that CRT is holding as well. CRT, the leases that they hold are all freehold. And CRT is not subject to the gearing limits imposed by MAS on REITs because essentially CRT is a business trust. So talking about gearing, current gearing is about 47%. So people might be worried that if they're already slightly above the the recommended MAS ruling cap of 45%. But point number one is that firstly they are not uh, restricted by that cap, and secondly, per our talks with management, what they are comfortable with and what they have said that they will try to maintain is that in the long run they will try to maintain a prudent 45% gearing ratio. Currently it's 47%, but that being said, because in the general climate there in Japan and on the back of Abenomics where Japanese interest rates are expected to stay low, like for instance, if you look at the acquisition that CRT had for one small late last year, they took up a 5-year fixed rate debt, 5-year fixed rate debt, and the interest rate for that debt is only just 1%. So if you are getting debt at 1%, I think if you want to do equity acquisitions is easier. And given that note, management has said that they will try to balance between maintaining a prudent gearing ratio and maximizing shareholder returns. As for new acquisitions in the near future, we saw that CRT they were actually offered this Chinese development by their sponsor. They have the ROFO for that, and but that happened in the last few months, but they have actually rejected that. Going forward, they are still on the lookout for good malls to acquire, but I guess for the next 12 months, from the sense and from the tone of management, I guess for the next 12 months, their focus will be more on organic growth. Hi, there's a question on concerns about the Jap yen again. So the question is that long-term trend for the yen seem to be weakening against the Sing dollar. And even though the DPU is hedged, there's a limit to how long this hedge is going to be. And ultimately, in the long run, shareholders will feel the effects of weakened yen. So how do we mitigate this risk? I think weakening of the yen, there are many ways to look at it. So firstly, what we are seeing now is that on the back of Abenomics, yen is yen is weakening because of all the money printing. So they have this target inflation rate of 2% that they want to hit. So no one knows now when this 2% is going to be achieved. And once that is achieved, we might actually see that the QE starts to unwind. And similar to what you're seeing for the US dollar now, once that the reversal happens, you could actually see a reversal of the weakening trend. And the second point is that inflation, if it were to be able to hit the 2% target for the Japanese central bank, right, the inflation would actually mean that landlords would be able to charge higher rents. So that could actually have an offsetting effect on the weakening yen as well. And if you talk about weakening yen, we shouldn't just consider it in isolation to weakening uh, weakening DPU translated into SGD. Yes, it will hurt, but then a weakening yen could also mean that right now we see a lot of Japanese corporations, because of the weakening yen boosting exports. You see corporations like Toyota, they're actually reporting record profits. And when that happens, in line with what PM Shinzo Abe is trying to do in trying to get a lot of corporations to raise wages for the Japanese. So when profitability is boosted, you actually see that corporations, they have more buffer to increase wages. And when that happens, that could actually be a boost for consumption as well. So to look at it in just a single dimension of it affecting it, the weakening yen translating to lower Sing dollar use, that is a very valid point. But I guess there are other pros to a weakening yen for domestic consumption as well. Hi, another question on gearing as well. So it is true that gearing for the past quarter, they've been lowered to 47% on the back of higher asset revaluation. So at 47%, the question is, could this result in a cash call for more working capital? But for CRT's case, we know that CRT is a business trust. They are not binded by the regulation that they have to distribute 90% of their distributions. So when a situation comes whereby they need extra working capital, there is always another option of withholding or paying less of the entire distribution out. So for CRT, in the IPO prospectus, they have actually stated that for the first 2 years, they will be paying out 100% of their distributions. And then post those first 2 years, they will aim to pay out 90% of distributions. So in our models, we have already factored that in the first 2 years, it was a full 100%. But going forward, our target price is predominantly built on the premise that they are only going to pay out 90% of their entire dividends, distributions. Okay, guys, if there are no more questions, we will end our webinar here today. See you around next week.